Hello, ladies and gentlemen, and welcome back. Well, every so often you look at a chart and you think, that's just not right. Well, we have to talk about it today because Credit Suisse is falling like a solid rock into the ground and it's now worth $3.29. Total market capitalization of a bank that most people know sitting at $12.43 billion. So what's happening exactly with Credit Suisse? Let's take a look right now together, along with our normal daily show of stocks, commodities, and cryptos. See you soon. Well, welcome back everybody to the Daily Show. We've got a great show today with everything jam-packed, including lead indicators, macro data, and the key levels that you should be watching right now. But let's begin by discussing Credit Suisse. So Credit Suisse is pitching covered bonds programs to international investors, according to a memo. And this is all very, very relevant news right now. Now, supposedly, these bonds are expected to be rated by AAA by Fitch, according to the memo. Yeah, all right, AAA. What do you guys think in the comments down below? When you see some of the data soon, you may not think they're as AAA as everybody believes. But basically, we're also seeing a huge restructure of the bank. So the last analyst in Credit Suisse's London head office has quit. They basically said, yep, we're done. This is all part of the restructure anyway. And it's clearly a bank in massive loss mode. It is just losing money hand over fist. Credit Suisse also is now doing a right sell-off, and this is spelling the worst year for its shares. Effectively, another 2.3 billion cash call, and this is now putting massive pressure on the bank. Effectively, this is all part of this broader capital raise worth 4 billion francs, which won shareholder approval last week. It's intended to help fund Credit Suisse's attempt to recover from the biggest crisis in its 166-year history. Yeah, that's great. Like, we're going to the shares, we're going to the stockholders, we're going to the debt market and saying, please bail us out for a few more months so we might be able to survive. This is the problem we face in these markets right now. Now, if we go back over and we have a look at the credit default swaps, which I've posted over here on Twitter, make sure to follow at FX Evolution if you're interested in finding out some of these things. We're posting a lot there, including some of our private memos, and you'll get them just by being a follower on Twitter. So definitely join us over at FX Evolution if you're interested. But here's the credit default swap rates. Now, everyone was alarmed over here. Should we now be more alarmed by what's occurring? Credit default swaps hitting an all-time high by far, 400 basis points above. And if you're not aware of what a credit default swap is, I would definitely suggest searching it in Google, jumping over to Investopedia and potentially reading this little component here. But in general, a credit default swap is a financial derivative that allows an investor to swap or offset their credit risk with that of another investor. To swap the risk of a default, the lender buys the CDS from another investor who agrees to reimburse them if the borrower defaults. So guess what? That's coming at a higher cost right now. What's that telling us? The market is getting spooked and the market is not very happy about this particular bank. And if we go back to the GFC, you can see where it was at the high over here. So wait a second, is this alarm bells ringing? Is this some kind of black swan event coming? Who knows? But it's certainly something that we must be really realizing here in the markets. Now, at the same time that we're at these highs, we're seeing some other things. So let's get into our general market discussion. We'll come back to Credit Suisse a little bit later. So smart money versus dumb money. Well, we've used this quite effectively this year to figure out kind of peaks in markets, or at least times where we should maybe be more cautious on the bull side and a little bit more bearish in terms of our thought process towards markets. We've seen a discernible shift. Smart money has dropped, dumb money has continued to be quite bullish, and this is something that has to be concerning for many investors and traders out there. If you're feeling really bullish right now, well, maybe the market's doing a good job on you, because this has historically this year been that turning point in these markets, and this is happening at the time of this recording in the video. Let's move over to, of course, what we're also seeing from the big wigs. This is the CEO confidence. Yeah, it's not good. The CEO confidence is in the ground. Basically, this is the total measure of CEO confidence in the United States versus the Sp500 earnings per share of a 12-month forward. So what you'll notice is that when they go rock bottom, the CEOs, that's not usually a good thing for valuations. And I still think that 2023, and make sure you follow and subscribe to this channel because we'll be covering every day through that time, will be a very tough time for potentially valuations in stocks, specifically highly valued stocks that, while they're already down quite a lot, could actually compress even further. What if some of them actually start making significantly less money due to interest rates being at a high rate for a long period of time? Let's go into some positives just quickly here about this time of year. Well, we technically usually are in what we call the Santa Claus rally, or the period of the market that's pretty bullish. Now, it actually doesn't start, contrary to popular belief, at the start of December. Usually there is a little pull up followed by a pick down that happens over the last 30 to 50 years. And the middle of December is where you actually start to get that Santa Claus rally. Now, will it happen in 2022? I'm not sure. This is just the statistics that are around, and it's always worthwhile noting these seasonalities that do play out. So if we're seeing like a pullback that happens into December 15th, 14th, maybe that's a time to be looking. If we see the positive signs on the charts, hey, you could pay attention to that in terms of Santa Claus rallies. The worst start to the year going into Thanksgiving, the data stats are usually not very good. You see the red ones here, and when you go over for the rest of the year, they're not that positive. So again, even if there is a Santa Claus rally, it's not expected to be a kahuna kind of big move, 10% or anything like that. That's not usually what happens based on the current data stats that we're seeing. Now, is there any hope? Because of course we've been negative here on Credit Suisse so far. Well, yeah, there probably is going to be hope. And statistically, when we've had bad midterm years, that is midterm election years, we've gone to incredibly good rallies through the next year into 2023. But what that could also mean, remember, is still further pain to come, followed by an amazing rally later on in 2023. We do know at this point, at least it's incredibly likely the US is in a recession. We also know that that's probably going to be called sometime around March to April of 2023 in terms of the official time they call it a recession. Somewhere around there is expected. The bonds market's telling us this. We'll look at that later on. 50% of all yields are inverted by far. That's not ever been wrong now in the last 50 years in terms of recorded history. Now, if that is to occur, will we see potentially a market going down? Well, recently we talked about a Fed pivot, which is the main bullish case at the moment for markets. Since the Feds usually pivot, they only pivot because the economy's sick. So we'll look at that a little bit later on when we get into the charts. But just remember that, yes, it looks pretty scary right now. Yes, you've got to be careful. This is the critical point for the stock markets. And we'll look at that very, very soon. Well, hello everybody. And of course, before we jump into the charts and we take a look at everything to do with the markets right now and the key levels we need to be watching, I just want to remind everybody that the Black Friday, Cyber Monday special offer is almost over now for, of course, our collaboration here with Tiger Brokers. If you're interested in finding out about how you can get a few extra special offers that are only available now for only a couple more hours, then you can check them out within the description down below. And do remember, some of the reasons we like the Tiger Brokers platform is really the utility and the extra information that they provide you as both traders and investors. You can see here they're constantly upgrading their charts and their information, and even like the live feed for news, it constantly refreshes itself. You can select important, all, select your watch list, all of those types of things. Now, a lot of people ask me this question: hey Tom, do you like using, let's say, the bid and the ask screens, or understanding the volume in the markets, reading the tape, these types of things? Yeah, of course, you should always be able to get access to this. You want to have that level 1 and level 2 data, which you can get through Tiger Brokers. And then, although this is at the time of after the close, you can then see kind of where the market is potentially setting up big buy zones, or where they've had big traded levels. So it's important to see these types of things, to have these at your fingertips, along with alerts and different platform charts. So if you want multi-charts, some platforms of course charge you for this action. Well, you can do it. If you want to then compare a whole bunch of stocks, or you want to compare a whole bunch of ETFs, you can do so straight away on the charts. So make sure you check them out today. And if you're interested, then of course follow those links. Thanks so much. So here it is. Here's the beginning of our charts today. Credit Suisse, $3.29. And again, if we take a quick gander over here at the GFC, the global financial crisis, you will notice that it's way lower than where it was. Now, it's not throughout all banks that we're seeing this sickness, but remember, when you have one of these big banks looking so bad, it may require a bailout. If we go over to the financial sector of the US markets, you'll notice that they are currently sitting on highs. So it's basically at a resistance where we've got a smart money, dumb money switch, and we've got a few other things. So we'll come back to this. Let's have a look at the VIX as well. Is the VIX calm? Well, it certainly is. It's back down to these 20 levels. This has historically been a very good point of turn for the markets this year. When we've had these 20s, we've had turns. When we've had these 35s, we've had turns. If you ever want to prove something like that, load up in your TradingView platform, or of course Tiger Brokers platform, load up some kind of comparison, bring them side by side and be able to check out what's going on here. So here we have, of course, the screen up, and you'll notice that we do have quite a lot of correlation with lows and market highs in terms of VIX, with highs and market lows in terms of VIX. VIX is a great indicator of fear and greed, and this is just it playing out. So at the moment, people are a little bit greedy. That's what this chart is actually telling us. Let's move over to yield inversion. This is incredibly yield inverted. I just wanted to put this here for effect for any new viewers out there, old-time viewers. You guys have already seen this before. But basically, we've got a multi-year, incredibly high yield inversion. That's telling us that the bond market is freaked out about the health of the US economy long-term. The US 10-year is dictated to as basically the market. So the market controls this rate. The US 2-year, an easy way, or the 3-month, is easily to be called the Fed. So the Fed's basically saying, hey, we're going to raise rates to kill inflation. And the market's saying, hey, you're hurting me. That's effectively an easy way to think about this. The Fed is hurting the market, and the market's telling the Fed, hey, we're sick. What are you going to do about it? So if we take a look at the US 10-year here, you'll notice it's sitting at 3.738. If we go to a daily, it'll just make it a little bit more apparent that it's quite weak. 3.73 versus the 2-year, which is sitting at 4.4, versus, of course, where we expect the rate to be in 2023. And this is a very powerful forward indicator. 5% is what is expected. So we know that there's a big discrepancy between where the rate is going to be in the future and where the market thinks the rate will be in 10 years' time. It shows a recession. It also shows sickness in the economy, and that's not something you want to see. Let's go over to high yield bonds. What are high yield bonds doing? Well, high yield bonds effectively have kind of sat lackluster a little bit in the last couple of weeks. They've been recovering, which is good, but they're not making new highs. They're not really blowing out, and we are still watching them. And high yield bonds will be very, very important to watch over the next coming months. And this is one of those things that you use to see recoveries. What about the US dollar? Well, we had a big buy up in the US dollar just the last couple of days. You can see here that we've got a huge rally coming through with strong demand spikes coming for the US dollar. We also see this nice big wick coming through. So new highs here should force US dollar to continue to strengthen. Is that showing us weakness in the stock market? Potentially so. Let's have a look at the last 2 hour. So here's the 2 hour, and you can see that huge big bull market. We expected the market to come down in the previous session and then rally. That's what it did. Fantastic. Do we expect further rallies? At this point, you've got to think so. Especially when we get new highs, you do have a little supply over here, but in general, it's kind of pushing that idea that pullbacks will be met by bull demand. And it all starts really on this particular candle here. That was a fairly strong movement. Is that consistent with what we're seeing on the euro? Yes, at this stage it is. We've got that strong rejection coming off that highlighted area that we thought was pretty good, a nice supply that was sitting there. We've got one rejection, interesting. We've taken the new high, very interesting. So we actually took the high, taking out all the poor stop losses here. I'm sure there's a few people with sad face right now. And then we've rejected that zone. We've also got another nasty looking candle of the previous day. So it's kind of saying that rallies should be met by sell pressure. Of course, alerts, if you're wondering where things get a little bit nasty, probably under 1.02, this level here for the euro. And that's going to confirm, I guess you would say, a doubling top, which pressures us down back into parity around that 1 level. So remember, with double tops or this type of strategy, you look at A equals B would push us into 1. That would seem pretty legitimate at this point. Let's move over to gold. What about gold? Well, gold did pretty much what we thought as well. A rally, very fantastic, into a potential sell-off, absolutely. And the time of this recording, it's sitting right around a tough area for it. It really kind of needs to short right now. We don't want, if you want gold to be up, then you're wanting it through 1770. At that point, you're just looking for gold to rally, break past here, and probably keep going. But if you are wanting to see gold get to a cheaper price, potentially you want to buy gold in the future. Of course, we are medium-term bullish here on gold for sure. The way that we're looking at these markets at the moment, potential stagflation and other reasons, then we want this market to come down probably into these levels. And at this point, it's at that turn zone. We saw a small shift in price in the previous session where it rallied and then it found some sellers. And what we're looking for is new lows here. So we found basically a higher high, and then we broke down, we rallied, and then we sold. We need to see sellers recommit themselves during the next 24 hours to the downside if gold is going to struggle, and of course, if dollar index is going to become strong. What about US oil? Well, US oil has almost hit the $80 a barrel, almost broken through this downward trend line pretty significantly. That would be, a fairly decent move for oil. You can see here on the daily, it's struggling as much as it can in its downward trend. And it looks like there's some OPEC cuts coming. What are they doing? They're trying to support their oil price as best they can. They're like, please don't sell oil off. I still think that there's a good chance due to demand destruction and other problems in the world that we still hit this $65 a barrel, which has been our long-term target all the way since 120 or whatever it was. And yeah, I mean, it's still weak. It's hit target number one. Fantastic. That's $75. We didn't quite get it over here, but we got the medium-term target here. We're still looking at 65 for the long-term target. And then at that point, hopefully we see some stabilization in oil. But in the last 24 hours, a big turnaround for it. And it certainly does look a little bit more bullish. I'd like to see 80 a barrel taken or even 82.50 before it can return back into those 90s. And people will be looking for that. This is mostly at OPEC getting involved and manipulating the barrel. Let's move over to Tesla. Tesla was down for the session. So we'll go into stocks now and we'll talk about some lead stocks, some indicators, some other things here. We know that Tesla's had a bit of a tough time recently. It's basically just up and down. It's not doing much. If it does weaken, still that 173 to 170, we've got that as a red box zone where we expect buyers to maybe show some commitment. And if we do make a new low, nothing changes over the last couple of sessions, guys. We still look for the market to potentially come back into this area here and then find those really longer term buyers. People don't like that, but yeah, it's possible. And remember, it's all based on if we take that weekly low. So here's our weekly rejection at the stage, maybe some potential buyers. But if we get underneath this wick, that's not going to be good for it. Do we have some other stocks that are starting to struggle? Yes, we do. Apple is not having a good time of it with Elon and Apple fighting. On top of that, we've got chip issues and shutdowns going on all over China. This is a big issue for Apple, and you can see the stock price is acting accordingly. 2.11% down for the biggest stock in the world. This is exactly what you don't really want to see. And if it does end up making a new low under here, it's pretty sick. We got alerted to the sickness when it dropped through here. The lower highs showed us that way, and it just doesn't look very good. Where a buy is going to show commitment, potentially around that 136, 138. But at this stage, leading in, that's not the chart that you want to have. And look here at the daily, at the weekly. Again, you can see those buy demands. I'm going to set a little alert just underneath here because there might be like an initial bang and then like maybe a buy up for a day trade. But overall, if it takes these lows, that's not going to be positive for Apple. And we could easily see it down in these levels that we've marked out before. Semiconductors are also struggling. We've been talking about this now for over a week. Semiconductors had an amazing run on them. Then they created an island. And at this stage, they're kind of consolidating on the weakness side. We've got quite a few other things showing weakness as well. Here's biotech coming up to this beautiful resistance. Notice how many sectors are all at resistance right now. Biotech, even ZOM or XLE, sorry. If we look at energy, take a look at this one. Again, sitting at consolidation at the highs. It could be that it's getting ready for a big rally, or it could be that this was all part of max pain and this is actually a distribution towards weakness. At this point, I'm favoring that mostly because of the Apple sell down and some of the under the hood reasons we don't like about markets. XLP, XLY, XLP, still not good. We're seeing consumer discretionary, 1/3 of the US economy coming in weak here to, of course, the Christmas period. This is not ideal. This shows us the American consumer, it's sick. It just is. Like, you can tell the charts don't like it. And look at this. And this is not good. Usually during nice recoveries, you see XLY versus XLP recovering very heavily. If it starts to go defensive like it is here, we're in a period of weakness in the economy. And it looks all the way since the GFC, since the global financial crisis, predominantly this has been a very bullish indicator, and it's been very, very nice. At the moment, it's made a new low. It's not really what we want to see. The DAX is also at a high, just kind of chopping around here at this supply. Again, caution. Bulls just need to be cautious. I'm not saying it's not going to go up. Could. We'll change our opinion if necessary. But at this point, it's at that resistance, at that supply. So obviously starting to struggle. US 100 made a new low thanks to Apple. Of course, the NASDAQ is weak. This is the lifeblood of the new economy in the US. So we're seeing that weakness coming through from America to do traditionally with pretty much anything to do with chips and manufacturing in China. And this has made a new low. So rallies could be met by, of course, sell demand. Is the NASDAQ the first teller here of weakness in the S&P 500? We've also got the Russell 2000, the smaller caps, starting to put pressure on the downside. Again, something to watch. But let's move over to the S&P 500. So where do we find ourselves at? Well, we find ourselves at the 200 daily moving average, almost at the downward trend line that's held this market down all year. The golden pocket, so that's the 61,866 area. And we made a new high on the real market, if you have a look here, which could have trapped some bulls in and then pushed them down. And we find ourselves here. So what scenarios do we have that potentially could go with those, the bull and the bear case areas? So I think from the bull cases, they're looking at two levels, where it is right now. We talked about this in the previous session, 39.40, 39.50. We hit the top, we found a rally, we dropped, and we made a new low. That's not too bad. That's still okay if we can do it. We need it now to clear 39.80. And if that happens, there's a good chance that the market will rally, and there's a real potential that we might get that 41.10 gap close that we saw all those months ago. That's the bull case number one. Bull case number two comes down to 3,900 and finds buyers. Okay, this is a defended area, a very important zone for the markets, and it'll be even more important when we look at options in just a few moments. So the market comes down, finds this area, maybe we see some buyers come through there. Now for the bears, they're looking at this as simple. I want to see this thing go low and take that low out. If that happens, probably will rally to suck in some buyers, but overall, there's a good chance of weakness from that point. So the bears are looking at this and they're saying, oh, delicious. We want to push down to 3,900, maybe take lows, possibly rally, and then dump. That's, I think, a case that is potentially here. What am I favoring? I really don't have too much opinion. I'm pretty neutral in this area. The market did what we hoped. It rallied into these supply zones that were previously here. That's exactly what we wished to happen off the bottom. Now we're saying, well, look, we can certainly make a case for 41.10 gap closes. And of course, that trend line on the way down, the 200 SMA, all of these things. But yeah, in here, the market's clearly just rotating and moving into sneaky and big ways. If we go over to the options, what's happening there for the options this week? Friday options expiration is interesting. We will look at the second here, 390. So remember that level, 390. Well, turns out there's a ton of puts sitting on that as well. So probably will be defended by bulls. And we've also got a 400, both calls and puts sitting around there. 397 is max pain, current stock price, 395. It's very plausible the market comes down to 390, finds some buyers, and then maybe closes just underneath 400 for the week. Would Wall Street be happy with that? The answer is hell yeah, they would. Why wouldn't you? And they make more money on the options. They expire a whole bunch of stuff worthless, and they sit in those levels. So I think there's some of the key zones that we are watching this week. Now, if Bitcoin's anything to go off, it just rallied. Remember back only a day ago, we were talking about this area here potentially being weak. Now, I think I did miss something a little bit there. I looked at it afterwards. There was certainly a potential buy in here that was pretty good. But look, the market it showed some signs of weakness. It looked like it was shorting and then just went ram, bang, huge movement up, big buyers coming back in. It's tapped into these highs over here. Look, this could be the signs of Bitcoin improving. It's possible and certainly quite plausible that it is. I'm not too sure yet. We'll come back to this one in the next video and see how it plays out. for the next move. I don't have too much opinions other than it's hit a very nice target sitting around these highs if you were long on crypto or Bitcoin. For the news ahead, we have quite a lot of news coming through, of course, here for everything that we've got the ADP non-farm employment change, 8:15 New York time. Then we have Fed Chair Papa Powell. He's coming out to have a chat. What will he say? 1:30 p.m. Wednesday, sure to move the markets. And then we go through CPI for CHF, core PCE price index for the US on Thursday, the ICM as well. And then we move into the big news, which is, of course, the non-farm job numbers themselves, 8:30 a.m. New York time. Be careful around this one, as we know this tends to be a huge liquidity event. Markets often move in one direction, then go the opposite direction. That is the nature of non-farm payrolls. They are very, very sneaky. So make sure you practice caution. Just a reminder, everyone, if you're interested in taking up Tiger Brokers on their special offer for, of course, the Black Friday into Cyber Monday, it is literally now the last couple of hours left for that. So make sure you go and check out the description down below if you're interested in getting some of those special offers. Otherwise, I just want to say a big thank you for everyone that subscribed and smashed that like button. And also thank you very much for the happy birthday wishes. Quite a few of you sent me those. I just want to say thank you very much to everyone in the community. See you in the next video. Bye for now.